Hi friends, I hope so you all are fine. Welcome to my YouTube channel. In this video we will discuss about capital structure. So come to my Google screen and see here capital structure. What is capital structure? Capital structure is a particular combination of debit and equity used by a company to finance its overall operations and growth. Capital arising from ownership share is a company and claim to its future cash flows and profits. Debit comes in the form of bonds issue or loans, while many comes may come in the form of stock, preferred stock or earning short term. Debit is also considered to be a part of a capital structure. Capital structure is how a company funds its overall operation and growth. Debit consists of borrowed money that is due back to the lenders, commonly with interest expense. Equality considers of ownership right in the company without the need to pay back any investment. The debit to equality ratio is useful in determining the riskiness of the company borrowing practice. Understanding capital structure. Both debit and equity can be found at the balance sheet. Company assets also listed on the balance sheet are purchased with debit or others. Capital structure can be a mixture of a company long-term debit, short-term debit, common stock and preferred stock. A company proportion of short-term debit. Long-term debit is considered when analyzing the capital structure. When analyzing refers to capital structure, they are most likely referring to a firm debit to equity DE ratio, which provide insight into how risky company borrowing practice are. Usually, a company that is heavily financed by debit has a more aggressive capital structures and therefore poses a great risk to investors. This risk, however, many to be prime source of the firm growth. Debit is one of the two main ways a company can raise money in the capital market. Companies benefit from debit because of its tax advantages. Interest payment made as a result of borrowing funds may be taxed. Debit also allows a company or business to retain ownership unlike equity. Additionally, in time of low interest rate, debit is and easy to access. E also outside investors to take partial ownership of the company. E is more expensive than debit, especially when interest rates are low. However, unlike debit, E does not need to be paid back. There is the benefits of the company is the case of declined earning. On the other hand, E represents a claim by the owner on the future earning of the company. Type of capitalization structure. Firm can either issue either more debit or E of funds its operations. By issuing E, firm give up some ownership in the company without the need to pay back investors. By debit, company increase their leverage by needing to pay back investors. A company debit to ratio in the measure of risk for investors. Special considerations. Companies that use more debit than equity to finance their assist and fund operating activities that are high leverage ratio and the aggressive capital structures. A company that pay for assist with more E than debit has a low leverage ratio and the conversation capital structure that set a high leverage ratio and the aggressive capital structure can also lead to high growth rates. Conservative capital structure can lead to lower growth rates. Analyze use the DE ratio to compare capital structure. It is calculated by dividing total by total equality companies have learned to incorporate both debit and equality into their corporate strategies. At times, however, companies may relate to having an external funding and debit in particular. Investors can mention a firm capital structure by tracking the DE ratio and comparing it against the company industry peers. Why do different companies have different capital structures? Firms in different industries will use capital structures better suited to their type of business. Capital in intensive industries like auto manufacturing many utilized more debit, while labor intensive and service orient firms like software companies many equality. How do managers decide on capital structures? Assuming that a company has access to capital, investors or lenders, they will want to minimize their cost of capital. This can be done using a weight average cost of capital calculating to calculate the managers to analyze with multiple the cost of each capital components by its proportional weight. How do analysts and investors use capital structure? A company with too much debit can be seen as a credit risk. How much equity, however, could mean the company is underutilizing in growth opportunities or paying too much of its cost of capital, and equality tends to be more costly than debit. Unfortunately, there is an magic ratio of debit to equality to use an audience to achieve real world optimal capital structure. What define a health blend of debit and equality varies depending on the industry that companies operate it in stage of development and can vary over time due to external charges in internal rates and regulatory environments. What measurement do analyze and investor use to evaluate capital structures? In addition to the weighted average cost of capital, metrics can be used to estimate the suitability of a company capital structure. Leverage ratio on one group of metrics that are used such as debit to E ratio on debit ratio. The fundamental of corporation finance and accounting. Whatever your learning style, understanding corporate finance and accounting is easy when you can choose from more than 1 lakh online video courses with Udemy. You will be able to learn accounting and how to prepare financial statement and analyze business transaction. What some each course has new edition published every month and come with a 30-day money back. Learn more about capital structure. If you like our video, please subscribe our channel. Thank you so much.